Welcome to the deep dive. We take your sources, break them down, and give you that shortcut to being truly well-informed. Today, we're diving into Veeva Systems. Now, this is a company you probably don't interact with directly, but believe me, they play this absolutely crucial, very specialized role in the life sciences industry. Our mission today, really understand what makes Veeva tick. We'll look at its unique business model, its tech, including their move into AI, its financials, which are pretty impressive, and, their long-term vision. We're drawing on quite a range of material today, analyses from the Motley Fool, high growth investing, reports from Ensemble Capital, and even Veeva's own recent Q1 earnings call for fiscal year 2026. So yeah, get ready to unpack this fascinating company. It's quite remarkable, isn't it, how a company can become so essential just by focusing laser-like on one industry, especially one this complex.
Absolutely. That's Veeva Systems, ticker VEV.
Yeah.
And yeah, they're not making games or social media apps. They build cloud software and platforms, but only for life sciences.
Right.
We're talking big pharma, biotech, medical device companies. That's their world.
Right. And what they do is super specific, helping manage clinical trials, which are, notoriously complex, navigating all the regulatory rules, which is just a maze, and even handling things like CRM and sales, but tailored completely for how pharma works.
Exactly. And that's their huge advantage, this specialist knowledge. It's not like buying standard software off the shelf. It requires this deep, almost arcane understanding of how life sciences operates, the workflows, the data needs, and especially the regulations.
I mean, just think about the rules involved in getting a drug approved.
Right. All that compliance, data integrity stuff, Veeva builds that into the software itself.
And because they've baked in all that specific knowledge, well, it makes it incredibly hard for anyone else to compete, doesn't it?
Massively hard. The cost and time to replicate that kind of embedded expertise, it creates huge barriers to entry.
Which leads to really sticky customers, I gather.
Very sticky. Our sources mentioned the average lifespan of a Veeva installation is over 15 years. That's incredible retention.
Wow, 15 years. It's practically a utility at that point.
It really speaks to the power of going deep in one vertical instead of trying to be broad. While everyone else is chasing hyperscale markets, Veeva just mastered this one critical niche.
And the numbers back it up, right? Their growth, their retention. It tells you the customers, even though they're not consumers, must really value it.
Definitely. Even the Motley Fool analysts we looked at, they rated the business highly, acknowledging how attractive it is to be that focused player.
Okay, so let's dig into the products themselves. This seems key to their success. They've apparently become a multi-product company, which is interesting, all built on their own platform, Veeva Vault.
That's right. Vault is the foundation. They launched it way back in 2012, and it's their own cloud-based content management system. Everything else kind of plugs into it. And they organize their products into two main clouds. First, there's the development cloud. This is all about R&D. Think clinical trial support, like Vault eTMF. That's basically a super secure, specialized system for all the documents a trial generates. Thousands of them. And then there's CTMS for managing the logistics of the trial itself. They also have Vault submissions for regulatory documents, Vault quality docs for manufacturing. It's comprehensive.
And this part is growing fast.
Yeah, the subscription revenue in the development cloud is seeing solid double-digit growth.
And I read something interesting how this helps tackle Eroom's law, which sounds bad.
It is, sort of. It's the opposite of Moore's law. Eroom's law observes that over time, it costs more and more R&D money to get fewer new drugs approved by the FDA. It's a huge challenge for the industry.
So Veeva's software is trying to make that R&D process more efficient.
Exactly. Boosting efficiency, streamlining things, trying to improve that return on R&D investment, which, is pretty important for all of us.
No kidding. And the adoption rate is high.
Extremely high. 19 of the top 20 biopharma companies use Veeva eTMF. That's dominant. And they're expanding, too. They just announced Veeva SiteVault CTMS, specifically for the research sites running the trials. There's a free version for smaller sites, subscription for bigger ones. That's coming in August.
Okay, so that's the development cloud. What's the other one?
The other half is the commercial cloud. This covers sales and marketing, again, specifically for life sciences. It includes their CRM solutions, marketing automation tools, like promo mats for distributing approved content compliantly.
Compliantly being the key word there, I imagine.
Absolutely crucial in pharma marketing. And they also have data products, like Compass transaction data, to help companies target the right doctors or institutions. This side is big, about half their revenue in fiscal 24.
Now, something that sounds like a massive project, the CRM migration.
Oh yeah, This is huge. So historically, Viva CRM was actually built using Salesforce technology.
Really? So they were paying Salesforce.
Significant licensing fees, yes. But back in 2022, Viva announced, okay, we're moving our CRM onto our own platform, onto Vault. Vault CRM became generally available just this past April 2024.
That sounds like a monumental task, moving all those big pharma clients.
It is a mammoth task. The migrations are planned mainly between 2025 and 2030. But the payoff is potentially huge. Bringing it in-house should really boost their gross margins. The projections go from around 72% gap now, potentially up to 80% by 2030.
Wow, that's a big jump.
And it lets them innovate faster, connect the commercial side more tightly with the R&D side through Vault. It makes strategic sense.
How's it going so far?
Pretty well, it seems. Over 80 customers are already live on Vault CRM. They're aiming for around 200 live next year, including 3 top 20 pharmas.
Are competitors reacting? Salesforce?
They are. Salesforce and another competitor, IQVIA, are apparently deepening their partnership. But honestly, Veeva's current market share here is just so dominant. It's a tough position to attack.
Okay, makes sense. And of course, AI. Everyone's talking about AI. What's Veeva doing there?
They have a major initiative, yeah. They're embedding AI capabilities right into their existing applications and the Vault platform, both on the clinical side and the commercial side.
What kind of things will it do?
The goal is automation, productivity. They're developing specific AI agents like a CRM bot or an MLR bot.
MLR.
Medical, legal, regulatory review. It's a huge bottleneck in getting marketing materials approved in pharma. Automating parts of that could be a big win.
Ah, okay.
They're also offering user-defined AI shortcuts. And there's a Viva Direct Data API and an AI partner program. First release is slated for December 2025.
So they're positioning themselves as the core data platform.
Exactly. They want to be the source of truth for life sciences data. And AI obviously makes clean, structured data even more valuable. It's a smart strategic move.
Speaking of smart moves, I saw a note about an acquisition, Crossix.
Yeah, they bought Crossix about 5 years back. It does marketing analytics for life sciences. And it's apparently grown hugely since then, now over a $200 million revenue run rate, about 3 times bigger than when they bought it. It's become pretty standard in the industry.
So they're good at integrating acquisitions, too.
Seems like it.
Wow.
It fits their pattern. Find something complementary, integrate it deeply, make it part of their indispensable toolkit.
This focus, this long-term view,
Yeah.
it feels like it has to come from the top, right? The leadership.
I think so. The founder, Peter Gassner, he's still the CEO, started it back in 2007, still owns about 9% of the company. And his background is interesting. He came from IBM, PeopleSoft, even Salesforce.
Oh, so he was at Salesforce.
Yes, but he apparently left because he saw that pharma had these really specific needs that weren't being met by generic software. He felt it needed its own purpose-built solution. It's quite a vision to start with.
And that vision seems reinforced by this public benefit corporation thing. That sounds unusual for a public tech company.
It is unusual. In 2021, Viva officially converted to a public benefit corporation, a PBC. One of the first large public companies to do it. It means their legal charter requires them to balance shareholder interests with the interests of other stakeholders specifically, their customers, employees, and even society and the planet.
So it's not just PR, it's legally binding.
Legally binding. They have to report on their public benefit performance. And you can see how this plays into their strategy.
How so?
Well, think about it. Their customers are trusting them with incredibly sensitive data, critical processes, often for decades, right?
Right, that 15-year average lifespan.
So being a PBC sends a powerful signal. We're committed to your success, not just our short-term profit. It builds immense trust. It's actually a competitive advantage, especially in that industry.
That makes a lot of sense. And I read they've avoided big layoffs too, unlike a lot of tech firms recently.
Yeah, that fosters a strong internal culture, reinforces that long-term commitment. The CEO has even said they aim to create more than $2 of value for customers for every dollar Viva earns. It's a different mindset.
Okay, so a unique strategy, unique culture. But does it make money? Let's look at the financials, because a lot of cloud companies weren't profitable for a long time.
Viva's different. They have been highly profitable for years. It's actually one of their standout characteristics. Their non-GAAP operating margin, for example, was over 35% in fiscal 24, expected to hit over 42% this year, fiscal 25, and around 44% in fiscal 26. Those are very strong margins.
And cash flow.
Huge free cash flow generation. Their margins there have recently been over 45%. It puts their Rule of 40 score, that's revenue growth, plus profit margin at around 60%.
60. Isn't 40 considered good for SaaS?
40 is the benchmark for a healthy, high-growth software company. 60 is exceptional. It shows just how well they balance growth and profitability.
And they're hitting their big targets.
Ahead of schedule, actually. They had a goal for a $3 billion revenue run rate by 2025. They hit that in the first quarter of their fiscal year 2026.
So now they have a new goal.
They do. Management's now targeting a $6 billion revenue run rate just from life sciences by the year 2030. Ambitious.
How did the latest quarter look specifically, Q1 fiscal 26?
Very strong. Total revenues hit $759 million, up 17% year over year. Subscription revenues, the core recurring part, up 19% year over year to about $635 million.
And profits.
Also strong growth. Non-GAAP operating income was up 34% year over year, hitting $350 million. That's a 46% operating margin for the quarter.
Wow.
Non-GAAP earnings per share, $1.97, up 31%. Billings look good, too. Normalized billings up 16%.
And the balance sheet.
Pristine. A fortress, really. About $6 billion in cash and short-term investments at the end of Q1. Less than $100 million in debt. Gives them enormous flexibility.
Now, there's something about an accounting change affecting growth numbers.
Yeah.
TFC.
Ah, yes. Good point. There's a nuance called termination for convenience, or TFC standardization. It's an accounting rule change that took effect in February 2023. Basically, it pulled forward about $90 million of revenue recognition into fiscal year 2025. So it made FY25's reported growth look artificially high and FY24's look a bit lower.
But it doesn't change the actual cash they receive.
No, doesn't impact cash flows or the total money they get over the life of a contract. It's just about when the revenue is recognized on the books. If you normalize for that TFC effect, their underlying subscription revenue growth is pretty consistently in that 15–16% range, which is still very healthy.
Okay, that's helpful context. What about their guidance for the rest of the year?
As of late May for Q2 fiscal 26, they're guiding for revenue between $766 and $769 million. That's about 14% year-over-year growth. For the full fiscal year 2026, they expect total revenues around $3.1 billion, representing about 13% growth. And crucially, they expect to maintain that really strong non-GAAP operating margin around 44% for the full year.
So continued profitable growth.
Exactly. Stable, predictable, profitable growth. That's the model.
All right, let's pull this all together. Market position, competition, the future outlook. How big can they get?
Well, Veeva estimates their total addressable market, just within life sciences software, is about $20 billion.
And where are they now?
Around $3 billion run rate, so maybe 12–15% penetrated. It suggests there's still a lot of runway for growth just within their core market.
Who are they selling to mostly? Big companies?
Over 1,400 customers globally.
Yeah.
That includes 47 of the top 50 global biopharma companies. So yes, heavily focused on large enterprises. But there's definitely room to grow more with smaller and medium-sized biotechs, emerging companies. They have offerings like Vault Basics aimed there.
And competition. You mentioned Salesforce and IQVIA pushing back on the CRM side. Anyone else?
Yeah, their main competitors are often cited as Metadata, which is part of Dassault Systems. Oracle has some offerings, IQVIA. But the key difference is, for most of these competitors, life science is just one part of their business. For Veeva, it's everything.
That focus gives them the edge.
A huge edge. The specialized knowledge, the product fit. It's hard to match if you're trying to serve 10 other industries too. Plus, their platform strategy with Vault creates that powerful moat. Customers start with one product, then add another, then another.
Averaging 3–4 products per customer, you said?
Yeah, in both the commercial and R&D segments. The more products a customer uses, the stickier Veeva becomes, the harder it is to even think about ripping them out.
Are there any headwinds, things slowing them down?
There are some short-term ones mentioned, maybe some softer spending in biopharma recently, some uncertainty around the U.S. Inflation Reduction Act's impact on drug pricing, and also some companies might be pausing IT projects slightly to figure out their AI strategy. This has apparently hit Veeva's services revenue a bit, maybe delayed a few subscription deals.
But the view is that this might be temporary, pent-up demand.
That's the argument. The underlying need for what Veeva provides, efficiency, managing complexity, speeding up drug development is not going away. If anything, it's increasing.
Right. Long-term trends seem positive. The need for efficiency, complex new therapies like gene therapy, the fact that cloud adoption in pharma still isn't fully mature.
All those are long-term tailwinds for Veeva.
What about the stock valuation? It got hit like other SaaS stocks.
Oh, yeah. It was trading way below its 2021 highs.
Yeah.
But the sources suggest it's considered more fairly priced now, the PE ratio still looks high, maybe over 50 times trailing earnings. But if you look at enterprise value to free cash flow,
Which focuses on the actual cash being generated.
exactly, that ratio is around 21, which, for a company expected to grow cash flow around 20% annually, looks much more reasonable, potentially attractive for long-term investors.
And finally, this expansion beyond life sciences. That sounds like a big shift.
It's potentially huge, yeah. It's framed as a long-term initiative. They're starting with building a horizontal CRM, aiming to bring fundamentally new innovation. They expect maybe the first few early customers by the end of this year. It's definitely something to watch. Could really change the growth story years down the line if they execute well.
Okay, let's try to wrap this up then. When you look at everything we've discussed about Viva systems, what really jumps out to you? For me, it's just the powerful demonstration that focusing deeply, becoming truly indispensable in one complex industry, can create such incredible, lasting value. They're not just surviving, they seem to be thriving because of that focus. You see it in the Vault platform, the AI strategy, even the PBC commitment. It all seems to reinforce that specialist position. Profitable, growing, tons of cash. It's quite a picture.
I agree. Connecting it to the bigger picture, Viva really makes you question the be everything to everyone model, especially in complex B2B software. In a world awash in data and AI hype, maybe the real sustainable value comes from companies that genuinely understand a specific industry's problems inside and out and build truly tailored solutions. That deep knowledge, coupled with the platform strategy, that seems to be their unbreachable moat.
So what's the takeaway for you, the listener? Perhaps it's a reminder that sometimes the biggest innovations aren't the broadest ones, but the ones that solve very specific, very difficult problems exceptionally well. And maybe that commitment to customer success, actually writing it into their charter as a PBC, maybe that's not just good ethics, but a really smart, hard to copy competitive strategy that builds that deep, enduring trust. Ultimately, this deep dive gives you a look inside how one company built and continues to build a leadership position by becoming absolutely essential to an industry as vital as life sciences.